Hello, everyone. Welcome back to Boss Economic World. I'm your host, taking you behind the curtain of the financial theater to see who's pulling the strings and who's just getting tangled in them. Today is December 19th, 2025. Merry Christmas, Happy Hanukkah, and for my friends in the city of London, Happy Confused Panic Day. If you looked at the headlines this morning, you might have thought it was time to pop the champagne. The Bank of England cut interest rates. Hooray! Free money is back. Buy the yacht. But wait. If you looked at the bond market, or the faces of traders in Canary Wharf, you didn't see a celebration. You saw the look of a child who unwrapped a big present only to find a pair of socks and a note saying, "You're cut off." So, what happened? Why did the old lady of Threadneedle Street give us a rate cut but take away the hope? Why is the pound sterling flexing its muscles while gilts are selling off like day-old fish? And most importantly, why does Governor Andrew Bailey sound less like a central banker and more like a nervous structural engineer looking at a cracking bridge? Today, we are going to dissect the truth behind this 3.75% rate cut, the 5-4 nail-biter vote, and why the global pivot party has officially been shut down by the police. Grab your coffee, or something stronger, let's dive in. Let's start with the raw numbers, because numbers don't lie, only the people interpreting them do. Today, the Bank of England's Monetary Policy Committee voted to cut the base interest rate to 3.75%. This is a near 3-year low. On the surface, this is the 6th cut in this cycle. If you zoom out, it looks like a nice, smooth slide down the mountain. But let's look closer at the vote count, 5-4. Friends, in the world of central banking, a 5-4 vote is not a consensus. It's a bar fight. It's the economic equivalent of a hung jury. It means nearly half the committee, 4 hawkish members, looked at the data and said, no. Absolutely not. Do not cut. They stuck to their guns. And the man in the middle? Governor Andrew Bailey. He switched sides. He joined the doves to push this cut through. But here is the kicker, and this is the core of today's drama. Bailey cut the rate, but then he immediately grabbed the microphone to tell everyone to stop expecting more. In his interview following the decision, Bailey dropped a phrase that sent algorithms into a tizzy. He said that room for reductions in 2026 is more limited and that future decisions will be a closer call. Translated from central bank speak to English, we are cutting today because the rulebook says we can, but we are terrified that we are about to make a mistake. So, don't bet on this continuing. Why the fear? Because they are terrified of the neutral rate. We need to spend a moment on this concept because it was the star of the show today. The MPC's new language warned that decisions are finely balanced as they edge toward the neutral interest rate. Imagine you are driving a car downhill. Restrictive rate, you are slamming on the brakes. The car slows down. Expansionary rate, you are hitting the gas. The car speeds up. Neutral rate, you take your foot off both pedals. You are coasting. The speed neither increases nor decreases. The BoE is saying, we have been braking for 2 years. We are slowly lifting our foot off the brake. But we think we are almost at the point where we aren't braking anymore. If we cut more, we might accidentally hit the gas. Bailey believes the UK economy is very close to this neutral level. If they go below 3.5% or 3.25%, they might reignite the inflation bonfire they just spent 3 years putting out. This is why they are signaling that the easy cuts are over. The low-hanging fruit has been picked. Now, they have to climb the tree, and they are afraid of falling. To truly understand why the market threw a tantrum today, you have to look outside of Britain. This isn't just a UK story, this is a global narrative shift. For the last 6 months of 2025, the global narrative was the Great Loosening. Everyone thought central banks would synchronize their watches and cut rates back down to 2% or 2.5%. Well, reality just walked into the room. The ECB, yesterday, they left rates unchanged at 2%. Why? Because some officials are actually talking about hiking again. Hiking? In this economy? Yes. The Fed, earlier this month, the Federal Reserve projected just one solitary cut for all of 2026. The American economy is running too hot, fueled by tech stocks and deficit spending. Australia and Canada, speculation is mounting over rate rises. So, when Bailey comes out today and says, the pace of cuts will ease off, he is joining a global chorus. The era of synchronized easing is dead. We are entering the era of high for longer. Again. Traders, who are essentially adrenaline junkies, hate this. They were betting on 37 basis points of cuts next year. After Bailey spoke, they trimmed those bets. They realized that the central banks are not here to save the stock market, they are here to ensure money doesn't become worthless. Now, let's look at the truth behind the economic events that justify today's cut. Bailey cited that inflation dropped to an 8-month low of 3.2% in November. This was a pleasant surprise, the BoE had predicted 3.4%. But here is where we need to be analytical. Why did inflation drop? Was it because the economy is efficient? Was it because productivity soared? No. It was largely because of Chancellor Rachel Reeves. In the November 26 budget, the government decided to freeze rail fares and prescription prices, and they knocked £150 off annual household energy bills. Reeves herself bragged in a letter to the governor that her decisions lowered inflation by 0.5 percentage points. This is what we call administrative deflation. It's artificial. You are suppressing prices by government decree, not by market forces. The BoE knows this. They know that once those subsidies wear off, or if energy prices spike again, that 0.5% benefit vanishes. Furthermore, let's look at the labor market. This is the real headache for the hawks. Wage growth is still chugging along at a pace inconsistent with a 2% inflation target. British workers, quite rightly, want to be paid more. But if wages keep rising while productivity stays flat, businesses have to raise prices to pay those wages. That is the wage price spiral, and it is still lurking in the shadows. This explains the split vote. The doves, look. Headline inflation is 3.2%. The economy is stagnating. We must cut to save growth. The hawks, that inflation drop is a government trick. Wages are still hot. If we cut now, we are just pouring gasoline on the embers. Both sides are right. That is why the market is confused. Let's talk about the reaction in the financial markets, because money talks louder than press conferences. Usually, when a central bank cuts rates, bond yields go down. Why? Because lower official rates make existing bonds with higher coupons more valuable. But today? Gilts sold off. The 10-year yield erased its earlier drop. Why? Because the market is forward-looking. They don't care about today's cut to 3.75%. They care about where rates will be in December 2026. Yesterday, they thought rates might be 3%. Today, after listening to Bailey's cautious tone, they realized rates might stop at 3.5% or even higher. If rates are going to stay higher for longer, bonds are worth less. Hence, the sell-off. Pooja Kumra from Toronto Dominion Bank put it perfectly on Bloomberg TV, they have not given a clear path. That comes as a disappointment to markets. Wall Street and the city hate uncertainty. They want a roadmap. Bailey gave them a compass that spins in circles. And look at sterling. The pound is trading stronger against the dollar at $1.3392. Why? Because if the BoE is going to keep interest rates relatively high compared to the rest of the world, holding pounds pays better interest than holding other currencies. A strong pound is good for holidaymakers going to New York, but it's bad for British exporters. It's a double-edged sword. We cannot ignore the elephant in the room, the British economy is barely breathing. The BoE warned today that output will stagnate in the final quarter of 2025. They previously predicted 0.3% growth. Now, 0. Flatline. This is the tragedy of the situation. The UK is stuck in a trap. 1. Growth is 0, which screams cut rates. 2. Service inflation and wages are sticky, which screams keep rates high. This is close to stagflation. It is the central banker's nightmare. This is why Deputy Governors Sarah Breeden and Dave Ramsden are sounding so cautious. They know that if they cut rates to stimulate growth, they might unleash inflation. But if they keep rates high to kill inflation, they might cause a recession. They are trying to land a jumbo jet on a postage stamp during a hurricane. The benign budget from the government was supposed to help, but traders see it as a temporary patch. The underlying health of the economy, investment, productivity, trade remains, in the BoE's own words, unchanged. And unchanged when you are stagnating is not a compliment. So, where do we go from here? What should you, the investor, the homeowner, the business owner, expect in 2026? 1. The slow grind is here. Matt Swanell from the EY Item Club hit the nail on the head. The committee indicated it is probably close to the end of its cutting cycle. Do not expect rates to go back to 1% or 2%. Those days are gone. We are looking at a terminal rate of around 3.5%. We are currently at 3.75%. That means maybe one more cut. Maybe two if we get lucky. That's it. 2. Bloomberg's prediction. Bloomberg Economics sees one more cut in April 2026. Then, a pause. They warn that the risk is the data might prompt the bank to move sooner, but the floor is solidifying. 3. The mortgage reality. If you have a variable rate mortgage, you get a tiny bit of relief today. But if you are waiting for mortgage rates to drop to 2% before buying a house, you will be waiting until the next ice age. The neutral rate conversation implies that the new normal for mortgages will likely be in the 4 to 4.5% range for a long time. 4. The political pressure cooker. Chancellor Reeves says, I know there's more to do. That is political code for I need the bank to help me. But Bailey has asserted his independence today. He is not going to slash rates just to help the government's polling numbers if inflation is still a threat. Expect tension between Downing Street and Threadneedle Street to rise in 2026. To sum up today's events in the Boss Economic World style. The Bank of England gave us a cut, but they slapped a warning label on it. They have effectively told the market, we are almost done. The aggressive easing cycle that everyone fantasized about for 2026 is evaporating. We are entering a phase of fine-tuning. The pilots are no longer diving the plane to gain speed, they are trying to level it off without stalling. The good news, inflation is lower. The bad news, the economy is flatlining. The reality, interest rates are settling into a new normal that is higher than anyone under the age of 40 is used to. My advice? If you are an investor, stop betting on a liquidity flood. The central banks are all signaling that the tap is being tightened, not opened. Focus on fundamentals. Companies that can survive with 4% interest rates will win. Companies that need 0% interest rates to survive are zombies, and the Walking Dead are about to get taken out. For the homeowners, take the 3.75% news as a small win, but budget for stability, not a miracle. And for Andrew Bailey? Good luck, Governor. You have to walk a tightrope between a recession and inflation, while 50% of your committee wants to push you off one side and 50% wants to push you off the other. That's the truth behind the economy today. Concise, brutal, and unfortunately, a little bit expensive. I'm the boss. Keep your eyes on the data, and hold on to your wallets. See you next time.